Hello, this is your daily dose of financial market trends. AMD just dropped over 8% as semiconductor profit warnings ripple through tech, and the Federal Reserve might be about to change how it measures inflation entirely. Let's break down what's moving markets this Wednesday morning. Heading into today's session, yesterday's close showed mixed signals across the major indexes. The S&P 500 finished at 7,428, up about 0.2%. The Dow gained over 1% to close at 52,147, while the Nasdaq dipped slightly, down 0.2 at 24,876. The VIX pulled back under 2% to 18.35, and the 10-year Treasury yield fell over 2% to 4.6. Let's start with AMD, which is dominating conversations across trading communities today after dropping more than 8%. The chipmaker is getting caught in the fallout from SK Hynix's disappointing profit results, which triggered a broader reassessment of the semiconductor space. When memory chip manufacturers start missing expectations, it raises uncomfortable questions about whether demand for AI infrastructure and consumer electronics is weakening faster than anyone anticipated. AMD's pullback reflects genuine concern that profit margins across the entire chip industry might be under real pressure. On the opposite end of the spectrum, MasterCard is climbing 2% and catching attention ahead of its earnings report tomorrow. The payment network is benefiting from a wave of institutional interest in blockchain infrastructure adoption on Wall Street. As traditional financial players build out crypto-adjacent services and modernize their payment rails, MasterCard stands to capture both the transaction volume and the technology licensing opportunities. Investors are positioning ahead of what could be a strong forward guidance story when the company reports. The S&P 500 itself, through the SPY ETF, is seeing unusually high discussion volume, with mentions more than doubling day over day. That kind of spike in retail chatter around the broad market index often signals uncertainty, people trying to figure out whether to stay exposed or rotate into safety. Given the cross currents we're seeing, with chips under pressure, energy volatile due to Middle East tensions, and the Fed potentially shifting its inflation framework, it makes sense that investors are debating their overall market positioning rather than chasing individual names. Amazon reports earnings tomorrow, and it's drawing attention for an unusual reason: tariff speculation. There's growing chatter that former President Trump, who remains influential in policy discussions, might push for new trade restrictions. And Amazon's massive import operation makes it particularly sensitive to any shift in trade policy. Investors are trying to game out whether management will address supply chain contingency planning on the call, especially as the company balances its retail and cloud businesses under very different macro pressures. Three macro scenarios are shaping how traders are positioning right now. First, Middle East oil supply tensions are escalating after major commodity traders like Glencore reported doubled profits from petroleum market disruptions. The bull case, sitting at 35% probability, assumes diplomatic efforts stabilize the region and shipping lanes stay secure. If that happens, oil prices would retreat from elevated levels, easing inflation and helping consumer-facing companies with lower input costs. The bear case at 25% envisions conflict intensifying near critical choke points like the Strait of Hormuz, which could push crude above $100 a barrel and force central banks to keep rates restrictive longer, benefiting energy stocks but crushing transportation and airlines. Second, semiconductor sector profit pressure is front and center after that SK Hynix disappointment. The bull scenario at 40% probability suggests memory chip demand rebounds through stronger enterprise AI spending and inventory normalization, allowing oversold semiconductor stocks to recover as the AI infrastructure thesis regains credibility. The bear case at 30% sees weak memory pricing as a signal of broader demand destruction, triggering a cascading sell-off across the chip supply chain as investors reassess valuations against deteriorating fundamentals. Third, the Federal Reserve is expected to reboot its inflation measurement methodology, which could fundamentally change rate expectations. The bull case at 45% probability assumes revised metrics show materially lower price pressures, enabling the Fed to signal cuts and driving a rally in growth stocks as discount rates compress. The bear scenario at 20% worries markets will perceive the methodology change as political manipulation, unanchoring long-term inflation expectations and pushing bond yields higher despite the technical adjustments. On the housing front, 30-year mortgage rates have eased to 6.58%, down over 2% from a year ago. That's helped push existing home sales up nearly 3%. But inventory is building to 9.3 months of supply and home price growth has slowed to less than 1% annually, suggesting the market is cooling into a more balanced state after years of rapid appreciation. This week's earnings calendar is packed. Amazon, MasterCard, and Apple all report tomorrow, followed by ExxonMobil on Thursday and AMD early next week. Guidance will matter more than the backward-looking numbers given the uncertainty we're navigating. 5 things worth watching from here. First, chip stocks are facing a genuine profit margin test, and the next few earnings reports will determine whether this is a temporary air pocket or the start of a longer correction. Second, payment networks like MasterCard and Visa could be building a new growth leg through blockchain infrastructure that's flying under the radar. Third, energy volatility from Middle East tensions creates both hedging opportunities and risk, especially for portfolios heavy in consumer discretionary names sensitive to input costs. Fourth, housing market normalization with rising inventory and slowing price growth could pressure home builders, but create entry points for patient real estate investors. And fifth, if the Fed actually shifts its inflation methodology, that's not just a technical tweak, it's a potential regime change for rate expectations and duration-sensitive assets. As always, this is educational content, not financial advice, so do your own research and talk to a qualified advisor before making any investment decisions. That's your Morning Market Digest for Wednesday, July 29th. We'll be back tomorrow morning with the latest. Trade safe out there.